Hello and welcome to Money Life. This is Sucheta Dilal. Today we're going to talk about what seems to be emerging as another IPO mania. In fact, those of us who have been covering stock markets for over 30 years would like to say the roaring 90s are now turning into the swinging 2020s. Question is, retail investors got hurt really badly in the 1990s, again after the dot-com boom. Is it going to be any different this time? Are they going to emerge unscathed? Let's take a look at what's going on and what people need to know. When it comes to initial public offerings, we are literally back. Companies have done well. There's a rush of investors wanting to apply. People are crazy. They don't want to read. And this entire boom is coinciding with a number of new investors who come into the market. Remember, India's investor population has been 20 million for a really long time, decades and decades. After the pandemic, while people have been sitting at home, the SEBI chairman talked about how 1 crore or 10 million new accounts were added. These are new investors that came into the market. Just last week, the National Stock Exchange issued a press release that said 5.13 million investors had been added on in just 4 months of this financial year, which is April to 25th of July 2021, which means 15 million new investors in a market which has had 20 million investors only for decades. These are all new. They have not even seen a serious decline in the market. Forget about a prolonged bull run. They think prices have to keep going up, up and up. And any time when there is a serious blip and stock prices fall, there is such anger and hatred that you see on social media and huge losses because many of these young investors are so cocky and confident and trading in options, derivatives, they're using algo trading, and now they are queuing up for IPOs. For this video blog, I'm going to only talk about IPOs. In fact, you have to look at the mindset of these new investors. In fact, all of them entering the market has coincided with the hugely popular series Scam 1992, and which has such a sympathetic portrayal of Harshad Mehta. And many of them believe that if he was allowed to carry on for another 30 years, ramping up stock prices, India would have been a different country. So these are the people investing today who think that everything they touch has to move in one direction, which is up. Unfortunately, life does not work like that. And if they open their eyes, use technology which is available to them, just Googled a little bit, then they would know how things panned out and how history seems to be repeating itself. So what you have today is the huge success of Zomato, there's Barbecue Nation, Burger King, all of these which are very, very well-known names, seem familiar, have no profits, but people are investing in them. In fact, the number of companies coming into the market without profits but huge valuations is increasing every day. I'm going to come to it in a little bit, but let's look at the contrast. So in the 1990s, there was a nice dubious nexus of bankers, investment bankers, brokers, underwriters, mutual funds, and of course the media, which gave glowing reports, never wrote anything negative. All of them were operating like a cabal because each one had money to be made. Everyone on commissions, underwriting commission, brokerage, whatever. The media got advertisements and investors were taken for a ride. But at that time, they had only newspapers. Television channels also were very new and there was very little IPO analysis happening seriously anywhere. Not that they would have done any serious analysis because they also would have been looking for advertising. This time, every expert worth his salt is actually warning retail investors. Information is available all over. It's available on Twitter. It's available in blogs. Anybody who wants to look seriously cannot be taken for a ride if they make the effort. Question is, are investors listening? So, like I said, you want to look at the 90s, what better way than to look at Devashish Basu's book, Face Value, which has recently been re-released on Kindle. It's called Face Value, Creation and Destruction of Shareholder Value. You can always get it on Amazon. He writes first about how in the early 90s from 93 you had the global depository receipt boom. So a bunch of Foreign merchant bankers came to India in their dark suits, impressed people, and trawled the market for companies that had decent balance sheets to go and raise money abroad through GDRs. And all kinds of companies, even those who didn't need money, picked it up. So he quotes in the book, "I've heard an owner laugh derisively at foreign investors and market intermediaries after having successfully rigged his share price to dizzy heights and then made a GDR issue. He said, 'Oh, we have now seen these goras,' the white folks, 'they are no better. They're equally dumb and greedy.' His stock price shrank 95% over the next year, 3 years after the GDR. The whole process was so intoxicating that companies that had nothing to do with the capital market for decades had rushed to raise money." In fact, he writes further, the IPO mania began towards the end of 1994 and peaked in February 1995 after what was the MS Shoes scam. In Jan 1995, 145 equity issues opened for subscription. They included the mega issues of Reliance Capital, SR Oil, Jindal Vijayanagar, Hindustan Petroleum, etc. In one frenzied week in February 1995, at the very top, 78 companies went public. 1 week, crowning a financial year with 1,400 issues. You want to know the aftermath? You have to read on. All these companies went public at the peak of a bull run. Many of them collapsed. Retail investors, 3,000 of these companies actually vanished, raised investor money. Everybody made money except the investors, and they just dumped everything and walked away. There was absolutely no action. Companies which have struggled to raise money after that for a decade have not been able to fill the retail investor quota. Even their employees don't buy shares. Even the employee quota goes begging. Yet, things have taken such a 180-degree turn that I and Moneylife Foundation get emails regularly to say we need to fight and lobby for the retail investor quota to be increased because they don't want the oversubscription and they want a sure bet. Wouldn't it be better if they read a little bit? Of course, there's a big difference between the IPOs of 1990 and today. At that time, investment bankers actively helped hole-in-the-wall companies, literally with a table space and a small office in the suburbs. They had project templates which the investment banker took along with the broker, got the underwriting, got the funding, took the company public. Today, after 3,000 companies vanished, we know, and those of you who have followed us regularly know about how Midas Touch Investors Association went to court, had a good judgment from the Allahabad High Court in 2004 on what is famously known as the Vanishing Companies case. The court ordered a joint coordination and monitoring committee to be set up, which comprised SEBI as well as the Ministry of Company Affairs. 7 task forces were set up, but nobody, neither the ministry nor SEBI, had any serious intention of going after these promoters, tracing them, getting the money back, and most of all, returning it to investors. So lessons were learned, because for 2 decades after that, almost, the market has been dead, except that it came back with a bang during the dot-com bubble, which means lessons were learned for a very, very short time. There was a fall again. Companies delisted when things were bad. They want to relist again, and this is happening all over once again. Fresh money is available. There's a bit of a mania. Investors don't care. And so people are back raising money. So if you remember, after the market sort of collapsed, large groups like SR delisted many of their companies. Vedanta has tried to forcibly get investors out. Maybe it will change its mind now. It hasn't managed to buy back everyone. In fact, some companies are returning directly, like Chemplast Sanmar, which delisted its shares a decade ago, raised funds at 540 a share, which is a substantial multiple to its earnings as well as its delisting price, even adjusted delisting price. And DLF Holdings had done exactly that. So a decade ago, whatever happened, when there's boom time, companies get delisted. They don't want investors. When things are looking good, they want to come back. So DLF, Triveni Engineering, Bharti Tele, Prescott Mills, LG Group had all done this 15 years ago. What Chemplast Sanmar is doing now, it's raised money. The DLF story, in fact, is a great example of what you can expect regulators to do, because in 2007, despite a lot of complaints, SEBI allowed it to go public. And then in 2014, it finally completed its investigation and barred the promoters from the capital market. It's a ridiculously long period of time. They promptly went to the appellate tribunal, got a stay in 2015, and the matter is now languishing in the Supreme Court. This is what is going to keep happening. This is what happens in India. Now let's look at another company which is just going public, Novoco Vista Corporation. Moneylife has written about it. Here's a link. You can read an analysis in Moneylife. Carson Bhai Patel, the famous Carson Bhai Patel of Nirma, is floated this company. It's a cement company and India's 5th largest. Remember, Nirma itself delisted from the market a decade ago. But now that the cement company wants money, he is in the market at a premium. Like I said earlier, all this romance is caused by the success of Zomato and some of the other startups which are raising money, making losses but raising money. And people think that doesn't matter the losses, they're going to find an Amazon and a Google and a Facebook out here. It's important to know that exactly this kind of bubble happened during the .com. Everyone thought that any company that said it was in the IT business was like an Infosys and a Wipro and a TCS. So you had Ketan Parekh ramping up a whole bunch of companies like DSQ Software, Silverline, Avtech Infosys, Pentamedia, Global Tele, Himachal Futuristic, Tech and IT. Ramped them up and investors lost money heavily when the .com bubble burst. So let's not get carried away by tech startups and unicorns, because for every Facebook and Google, there are going to be a whole lot that just fade away. Like I said, every financial expert has been warning people, and nobody has said it better than Samir Arora of Helios Capital Management. Look at how he explains it. In a recent television interview, he says that this boom with the new tech unicorns is like a sugarcane machine. This is the first time the cane is crushed to get the best juice, which is taken by the insiders, promoters, the PE funds, because they are looking for an exit. Then the same sugarcane bundled with a few more is put through the crusher again, and what is squeezed this time is the IPO, which is at a fairly inflated rate. You're getting weak juice, not so good one, but you're rushing to buy it. And then it's bundled again and squeezed for the third time. And he says, this is what those gullible retail investors are buying, who are picking it up on listing and pushing the price up 20 to 30%, because they're buying it even higher than IPO price, because they think they're going to miss the bus forever if they don't pick up the shares then. Like I said, it's important to remember that for few like Amazon, Facebook and Google, there are so many that have fallen by the wayside and created losses. At the end of the day, nobody can protect a brash, ignorant, know-it-all investor from parting with his money. And this time around, there's no point in blaming the regulator. We have a disclosure-based market system. There's no point in whining about why SEBI should not stop these issues. At least in the 1990s, the control over capital issues was removed overnight, and people's mindset was that somebody, Sarkar, SEBI, has to look at it and looked at pricing. Investors don't have to. Today, investors know that they're supposed to read the prospectus. They are responsible. They have to look at the bottom line, and it is their worry. So I think more than investors who lose money, for whom we have limited sympathy, they rush into loss-making issues. The real worry is people who invest through mutual funds, because here are skilled fund managers who are supposed to make the right decision for you. They get in, they need to get out before the stock prices collapse, before the mania is over. So people should start studying what their mutual fund portfolios are very, very carefully. If you want to protest, this is the time. If you don't like what they're buying, write to the trustees, write to the regulator now. Keep a watch on your fund manager. Let them know that you are interested in what they're doing and you are watching them, right? Only the foolish will depend on regulators to act in time and protect them, because that can go on forever. If you like what we said, spread the word, warn other people, be careful, start reading, and spread the word about Moneylife. Thank you.